Okay. All right. The winner, and remember, you've got to be in the room to win this. So if I draw someone that's not in the room, I'm just going to throw the ticket over my shoulder. The winner of a smartwatch from this raffle drawing is Paul Cronin. Is there a Paul Cronin present? Raise your hand. Way to go. We actually have the gift right here, and our Olympian will run it back to you. Congratulations on your prize, Paul. All right, guys, let's give it up. Our next speaker, our next company presentation, a gentleman with a very strong name, Mr. Niel Marotta, the CEO of Indiva, is here to give our next company presentation. Let's give a big, warm Benzinga round of applause, please. Put your hands together. Let's go. Come on out, Niel.
Thank you. Thanks. So good to go? Okay, hi, everybody. I'm going to just lower this, if that's okay. Thanks, everyone, for taking time to come listen to me speak, and thanks to Benzinga for inviting me to speak on behalf of Indiva. My name is Niel Marotta. I'm the co-founder and CEO of Indiva. We are a licensed producer in Canada, and you can see a nice variety of the products that we make and sell coast to coast in Canada. Probably worth addressing right off the hop. We specialize in edibles. We are the edibles leader in Canada with close to 50% market share. We're very proud of the market share that we've built. We are not a multi-billion-dollar market cap. Our cap is about 65 million. We're very scrappy. We have a very talented team. And the thing that we do best is making finished goods. And most of the folks that work at Indiva are deeply experienced in CPG, both in operations, production, as well as distribution, marketing, and sales. You'll notice here, 90% of our revenue comes from edibles. It's not all that we do, but it's a vast majority of our business. And you'll notice that we sell actually Wana gummies. There was some pretty big news yesterday about Canopy acquiring Wana. This has no immediate effect on Indiva. We are still the exclusive producer and distributor of Wana gummies in Canada. And we'll maintain that right for at least another 3.5 years. So despite the announcement yesterday, for all intents and purposes, it's business as usual for us. We're very proud of the brands that we have and building them. I'll let you review these forward-looking statements at your own leisure. Management and the board represent directly and indirectly about 20% ownership. Sundial is also a major investor in the company. Our senior debt is all with Sundial, and they own about 15% of the company. There's some pictures of the products that we make at our facility. We have a 40,000 square foot facility in London, Ontario. That is the only facility we have, and that has been intentional. We probably went a very different route than many of the other Canadian LPs that were focused on scale, size, and a global footprint. Immediately, our view was, look, let's launch great products, let's build market share, and let's try and get to profitability as fast as we can. Maybe not the sexiest story in the world, but my background is in capital markets, and so we take profit pretty seriously. We've had a pretty good run here over the last 7 or 8 quarters. We got our license to sell edibles only in January of 2020. So prior to that, in many ways, we kind of feel like a 6-year-old company that's still a startup. Really, our revenue is starting to ramp. We introduced Bang Chocolate in February of 2020, and we introduced Wana Gummies to Canadians 1 year ago. So you can see the effect that's had on our revenue, and also our margins are starting to improve significantly. And that's being driven primarily by falling distillate costs, as well as some economies of scale. We don't give quarterly guidance, but what we have stated publicly is that we expect the second half of the year to be higher, greater revenue than the first half of the year, and we would expect margins to continue to increase. We think we can get our gross margins to close to 40% by Q4, so everything trending in the right direction. I'd also note that the first half of 2021, we generated more net revenue than all of 2020, so we're absolutely a growth story, and I'd probably be remiss if I didn't point out our trailing 12-month annualized revenue is about 36 million, and our market cap is still only about 60 million. Not many companies can say that, and we are a top 10 LP in Canada. We sell a pack of edibles every second in Canada. That is unbelievable product velocity. And taking it a step further, when you look at units sold, we're actually third in Canada behind only Tilray and Canopy. So maybe an underappreciated story, but I think there's great growth and value here, and I would encourage you to take a look. Won't talk too much about this. We're at about 2,500 stores in Canada. My guess is that will go to 3,000 plus before maybe we retreat a little bit. Our penetration is somewhere around 75 to 80% of all stores having at least one of our SKUs. And so now our focus is shifting, not just where it's always been in terms of new product introduction and new SKU introduction, new license agreements, but also revenue per store. And so our challenge and our goal and what we're working on with key accounts is to make sure they carry the largest variety of Indiva SKUs possible. I want to talk about edibles for a minute. We signed our first licensing agreement with Bang Chocolate in 2018. So we were very early. Edibles did not become legal in Canada until early 2020 for all intents and purposes. So we were sort of, hate to use a corny Canadian hockey analogy, but trying to go where the puck is going. And so when we look at American markets and we look at mature markets here for a lot of product knowledge and guidance, edibles make up upwards of 15% of the total pie. That number is smaller in Canada now. It's only about 5%. So we see that opportunity in Canada as being very bullish. We think the category can double or triple. And the overall Canadian market, which I'll talk a little bit about here, is running at about $4 billion a year of retail sales. We think that can also double or triple. So if we're successful at just maintaining our market share, we think that's a sort of 5 to 10x revenue opportunity for the company, and that's what gets us excited every morning. This is just a chart here. I'll run through these quickly. I won't bore you with graphs, but you can see how the edible category has grown as a percentage of the total market, starting at 0 and reaching almost 5%. It's important to note that edibles are still illegal in Quebec for the most part. That would add probably another 100 basis points to this number. Another challenge that we're facing, and I co-chair an edibles caucus with the Cannabis Council of Canada. The Cannabis Act in Canada is under review right now. That will take about a year. And our goal is to try and influence our regulator in a way that allows us to have more than 10 milligrams of THC per package. That is currently the federal limit in Canada. That is too low. That actually creates a public safety issue where now you're driving consumers back to the illicit market, not just for value, but for higher potency edibles. It also doesn't really match up properly, in my opinion, with some of the other products that we sell and are available in the market. For instance, we sell gel capsules, and we can have up to 1,000 milligrams of THC in one bottle. So we're hopeful that increase in THC limit will also spur the growth of edibles as a percentage of the total pie. You can see from this graph how the total edible category has grown. Gummies make up the majority of sales, just like they do in the US. Chocolate's number 2. But what I'd point out is that very thin gray bar at the top of this stacked chart. That's the other category, which in mature markets is more like 25% of the total. In Canada, it's only 5%. So we think that's a very clear area where, let's say, increased product breadth and innovation can actually drive the total category. We lead in gummies. We lead in chocolate. We recently launched a baked good from a company called Slow Ride Bakery. These are cookies. And after a month or two, we actually lead the baked goods category. So when we say we're dominating the category, we really mean it. And this is a way to look at on an LP by LP basis, so not consolidated on a corporate level. We were actually 11th. This is market share data from August, so relatively recent. And we got there, for those that think the edible category is too small, it's certainly big enough to make us the 11th biggest LP. And you can see that big bar at the bottom is sort of the remaining 100 plus LPs in the country. This is just another way to show how our rank in the country has increased as we've grown our edible sales, both in Ontario and nationally. And this is actually a graphical representation of our market share. The orange bars show, sort of that 40 to 50% range that we've been in for most of this year. And we wake up every day hoping to grow that further. The black line represents our total market share at north of 2%. One more look here. Gummies, we're close to 50% market share, and chocolate, 35 to 40%. And this is, when we talk about being a top 10 LP, this is from Raymond James, who covers our stock on a consolidated basis. We are one of the top 10 LPs in the country. I would note here that none of these other companies have a market cap under 100 million. Some of them have market caps of 5 to 10 billion. So I think there's a pretty significant gap and maybe a disconnect between the success we're having in our business and the valuation in the market. This is really just trying to show graphically. We may drop this chart. It's starting to get a little bit busy. 2 years ago, we had one lonely check mark up in the top left corner. We were selling pre-rolls in Ontario. Now we sell a variety of products in all 10 provinces and 2 territories. And we also distribute our products medically coast to coast through Shoppers Drug Mart. I like this slide. This is one of my favorite slides. Very proud of the team that we've assembled at Indiva. Most of these folks are deeply experienced in CPG. Our chief commercial officer spent time with the beer store, which is Ontario's beer vendor, and in other senior marketing roles in the cannabis industry as well. Our COO and our VP Ops probably have about 50 years of combined CPG experience between them with companies like General Mills, Bondwell, and Nestle. We produce about 1 million units a month, again, and sell close to that number. That makes us third in the country. This business is very tough to produce product at scale. It's not just the production, but it's the last mile that's difficult. In Canada, and I apologize if this is a little bit pedantic, but we need a different excise stamp for every province. So if we have 30 SKUs, what it really means is we've got 360 SKUs when multiplied by 12 provinces. And so having a talented team that knows how to produce product at scale, particularly food product at scale, has been hugely important to us. Now the food just contains cannabis. These are a variety of brands. Part of our strategy has been to license award-winning U.S. brands like Bang and like Wana and bring them to Canada. Again, my background in capital markets makes me fairly risk-averse, and we didn't want to go through any science experiments. We took a little bit of criticism for this. You know, the narrative was, why would you license a brand in a nascent industry with very little brand recognition? My answer is, well, if it's award-winning and people like it in California and Colorado, it's a very good bet they'll like it in Vancouver and Toronto, and I think our market share has proved that to be correct. The Artisan Batch brand is actually an in-house brand. We do sell super premium flower. We don't grow it. We don't extract. We focus on putting these ingredients together into great final products, and so we source from the best craft cultivators and micro growers in Canada for Artisan Batch. Slow Ride, we talked about briefly. That is an independent processor based in my hometown of Ottawa, Canada. They produce fantastic cookies. We buy the cookies from them and we distribute nationally. So we're a partner to many other smaller LPs, whether it's flour or cookies, and I would expect we'll continue to grow in this fashion, bringing great products to market that aren't always necessarily produced by us, but are marketed and distributed by Indiva. Some other products at the bottom: Jules, Ruby Sugar, and Sapphire Salt. These were licensed again back in 2018 from a company called Deep Cell. And maybe it makes sense for me just to walk into the products now, but you can see some of the Indiva and Artisan Batch branded products, sort of the 1.0 products, capsules and pre-rolls and flour. This is our Wana gummy selection. We've got some more interesting products that we'll launch later this year from Wana. We've got 7 Bang chocolate SKUs with an 8th seasonal SKU coming to market here shortly. And Bang milk chocolate actually was, I believe Jamie Pearson, the CEO of Bang, is speaking this morning as well. I would encourage you to listen to her talk. But Bang milk was the #1 selling product in Ontario for their fiscal year by units. So the most popular product in the province, and by extension, you could probably say the whole country. Very proud of that. You can see the cookies that we've launched towards the bottom. And then we get into the Jewels, which are really like a sweet tart. These are products that don't really exist in Canada, believe it or not. And so we think there's lots of innovation left going forward. And whether we invent the product, whether we purchase it, or whether we license it, we're open to all three. These are some pictures of the trade marketing efforts that we've put into place. Really, our goal now is we've hired several key account managers, and our goal is to work with the larger retailers and even some of the medium-sized retail chains in Canada to ensure that we have a terrific brand presence in store and that those stores hopefully carry as much as our complete lineup as possible. I believe these pictures are from the Tokyo Smoke in Dundas Square. For any of those that are familiar with Toronto, it's a very, very high traffic store. And I believe actually Tokyo Smoke is opening up another store in the Eaton Centre in Toronto tomorrow. Was their grand opening, and we'll again have very interesting displays for all of our products in store. Now, one of our strategic partners is Sundial. They own Inner Spirit, which is about 100 stores under the Spirit Leaf banner. They recently acquired Alcano, which is the majority stake in Nova, which has another 60 plus stores. So we're very happy with that relationship. We think we can work together and make sure that our products are well distributed in those stores. But we're very keen to continue to push this trade marketing effort. 95% of all sales that happen in Canada are in store rather than online. There's close to 2,000 SKUs in Canada that are available. Most stores won't carry more than about 400 or 500 or have them available in their cage. They just simply can't store 2,000 different SKUs. And then in terms of how many are on display, maybe it's somewhere between 50 and 100, depending on the size of the store, maybe less. So having that presence in store is hugely important from a marketing perspective because it creates a conversation between the customer and the bud tender. And as most of you probably know, the bud tenders have an enormous amount of power in this industry. I won't bore you with all the corporate development that's gone on over the years. Clearly, our business is accelerating, and we do have research coverage now from both Raymond James and Echelon up in Canada. I would encourage you to reach out to those analysts if you're curious, and more than happy to take your questions, if there's any.
Any questions from the crowd? We've got that microphone right there in the middle for you guys. Well, I have a question. Forward-looking, what should investors most be attuned to in the next 1 to 3 years?
Well, I think new product introduction, more line extension on our products, and growth in the edible category. I think the next 1 to 3 years, I would expect the growth in the edibles category to outpace the overall market as we catch up to, let's say, the split that we see in the U.S. And I would expect people, if they're taking a look at Indiva, we'll have a lot of new products coming out over that time frame. Some of which we probably haven't even met yet, but we're a terrific partner. I think we've done a great job launching Wana. Just to give you an example on the Wana, and I think Canopy announcing this option to acquire Wana is a real testament to their brand and the licensing model. So we're very excited about that. We think there's an opportunity to deepen that relationship. But we met Wana originally, it was less than 2 years ago. It was at MJ Biz in December of 2019. We had signed a licensing agreement with them by March of 2020, and we had national distribution of their products by September of 2020. And this is now just past the 1 year anniversary. So I think that's really a testament to what a great partner we can be for licensors and just how switched on our team really is at launching new products. We're very good at this.
That's great. And then are there any external factors or catalysts that you're uniquely poised to address that you see coming on the horizon?
Well, hopefully regulatory change and having a certain amount of dialogue with our regulator, Health Canada, on this review of the Cannabis Act to try and encourage higher potency for edibles as a public safety issue rather than a Scrooge McDuck issue. I think that's going to go a long way to boosting the whole category and continuing to provide great products to Canadians. And look, I would say the blue sky for our company is really international growth. We've talked very little bit about that. From Canada, we really have a platform to be able to export products if and when we choose to do so. But I think having a very strong position in Canada poises us to do that. In terms of our profitability, I think there's a very good chance that in 2022 we can be earnings positive, which not many companies are prepared to say. But we run the company very lean. Our margins continue to improve, and hopefully that'll get reflected in our stock price sooner than later.
That's excellent. And just one final question. So you mentioned that you have a background in capital markets, and that's the higher emphasis on profit being an outcome of that. Do you see any other areas throughout the supply chain or in the industry where that's not the case?
In terms of, I'm sorry.
I'm just trying to draw a contrast between how you're operating versus what you see throughout the industry.
Sure. I mean, without throwing too much mud at anybody specific, I think we often see companies reporting G&A levels that are above net revenue. And in the same press release, again, I'm not going to name names or speak specifically, but in the same press release, you'll often see them talk about a path to profitability. I can't imagine how you get to profitability from here in Canada if your G&A is above your net revenue. It just It just doesn't make sense. There's too much erosion in market share and too much competition for that to make sense.
So that's something any investor should be looking out for when they're looking for an opportunity.
I think anybody that's investing in the Canadian landscape, really needs to stress test some of the profitability models that are out there. Our quarterly G&A is $2.5 to $3 million, which probably sounds laughably low, but our net revenue last quarter was $9 million. Our gross profit was over $3 million, and I would expect those margins to continue to go up and continue to see operating expenses as a percentage of net revenue down. That's not something that's paid nearly enough attention in this industry, and I think people really should take a look.
Very exciting stuff, Niel. Thank you very much.
Thank you.
All right, everyone, give it up. Niel Marotta, Indiva.